Hello, my people. It's a great pleasure being before you here again. And I'm glad you are still here watching my videos. Anyway, we have been talking about financial management all this while. And we all know that finance is the life of any business. That is, capital, financial resources is the blood of any business. That is what makes the business going. Just like we have blood in the human, which keeps a human being alive. Also, the blood of the business is what is finance. By this, therefore, for a business to survive, for a business to start or to do anything in business at all, you need what we know as finance. And finance can come in different form. So therefore, today, we are looking at sources of finance. And these sources of financing your business. If that is the case, you can categorize the sources of finance basically into three categories. What we know as what the short-term sources of finance, the medium-term sources, and the long-term source. The medium-term source of finance, the short-term source of finance rather, the medium-term, and the long-term source of finance. These are the classification of finance, of how to get money to do or to run your business. By that, therefore, a major characteristics, a major distinguishing factor between the short-term, medium-term, and long-term is that a short-term finance, it is a finance that operates, that is given to you, on which you are going to pay back within a short period of time, usually 1 year. The finance you get through this source, through the short-term source, it means you are going to pay it back within 1 year. That is why it is termed as short term. You're going to pay it back within 1 year. So why the medium term source of finance? This is a classification of finance in which you are going to pay back the loan within 2 to 5 years. This one runs to anything that exceeds 1 year. So from there from anything that exceeds 1 year up to 5 years is to medium term source of finance. So within 1 year, 1 to 5 years, we have anything that exceeded that 1 year. So that fall within that 1 year and 5 years, we have the classification under medium source of finance. So therefore, anything that now expand more than 5 years and above, we have it for a longer period of time, they are classified as a long-term source of finance. If that is the case, therefore, we are seeing why it is called the short-term source of finance, the medium-term sources, or the long-term source. We have seen why it is called that now, because of the duration of period involved in paying back this finance, in paying back this loan, this money you have used to do to support your business. Now, what are the methods of raising the short-term source of finance? Under the short term, we have ways of raising it are we have borrowing from friends and relatives. Borrowing from friends and relatives. Just approach your friend. Hi friend. Hi Ben. Please, I need so amount of money. I need to run a particular business. To borrow the money from your friend or from your relative. So such borrowings you are expected to pay back. If you are expected to pay back within 1 year, it's categorized as what? To short-term source of finance. So we also have borrowing from cooperatives. Borrowing from cooperative. So you join a cooperative society in your environment, in your neighborhood. So you get the source of finance from them. So from there you have to do what? You have to pay back within what? Within 1 year. It's another source of what? Finance. Akura. What do we mean by Akura? Akura, these are what you have enjoyed the benefit but you have not paid for it. These are benefits enjoyed in which you have not paid. For example, the employees under you, they have worked for you for a period of 30 days or 25 working days, as the case may be, 20 working days as the case may be, regarding what? Depending on the organization policy. So if they have worked for you and you are yet to do what? To pay them their salary, or electricity you have enjoyed, any service at all you have enjoyed and you have not paid for it, they are called what? Akuras. So by that, therefore, you are still enjoying what? That's what? Their money which you ought to have paid, but you haven't paid, you are still using it to do what? To run your business. It's what we call Akura. So therefore, it's another source of finance. Bank borrowing. So you approach a bank and you ask them to do what? To borrow you probably bank overdraft. Bank overdraft. So we can have here to be what? We can have what? Bank overdraft here. Bank overdraft, bank OD. So bank overdraft is a what? Another source of finance. You overdraw your account by so amount. So it is what? Also what? A sort you are expected to pay back within a limited period of time. It is what we call what? Bank overdraft. So that is bank borrowing. Mark you, we have other bank borrowing can fall within what? Medium term, depending on, basically it is the period of this payment that would make all these things to fall under each of this category. Anyway, so these are the short-term source of finance. Also, customer deposit. You estimate your customer to do what? To deposit for goods in which they want to buy from you. You ask them, okay, a customer approach you, I need to quantity of a particular product. You now ask the customer, okay, if you need this product, this particular period of time, you have to deposit. Most especially, this method is always used where we have scarcity of that what, where is high demand for such a product. Therefore, you can take the opportunity and ask your customers to do what? To deposit. They make deposit for such goods. By that, therefore, you use their money to do what? To finance your business. You have trade credit. What is trade credit? You buy from a supplier, and the supplier gave you a trading period of what? Let's say 30 days, or as the case may be. So the period in which you use their goods and which you have not paid for it is what we call trade credit. So you buy on credit. You buy on credit from your customer. So from there, you are using the goods. So it's another source of finance. Debt financing. Debt financing. So that is another source of finance. So in the case whereby you have a lot of debtors and you need finance, you can take it to a factor. A factoring house with that do what? You finance what? You give you such as agreed, whether factoring without recourse or with recourse. So give you what? Part of what? Even pay you in full of that debt and take charge of it. So they will give you the money in which of the debt you are still, in which your customer has not paid. So from there you can finance your business with that as well. Invoice discounting. Invoice discounting. So therefore, you told your customers that okay, we pay within so period, you can pay this. We're going to give you a discount of this particular amount. We pay within 5 days instead of what? The normal 30 days policy. So I'm going to give you so discounts. So they pay in time. So from there you can easily have fund to do what? To finance your business. Commercial papers. So it's another form of what? To financing what? of getting what? Of getting finance to finance to run your business. So those are what, and lots more. Those are the method of raising short-term finances. So medium-term finance. Medium-term, what are the method of raising it? We have hire purchase, we have lease, and sales and lease back, we have venture capital, we have project finance. So let me quickly throw a little light on what this medium source of finance means. I said we have hire purchase. What is hire purchase? Hire purchase is a situation in which ownership will not pass to the hiree until the hiree pay the final installment, pay the last installment. All remember that this is a contract between what? Two parties, the hirer and the hiree. The hirer is the owner of of the asset, in which the hiree is the person enjoying the benefit of the asset, that is to say, is one using the asset. So by that, therefore, you need to use the asset and be paying a certain installment to the hiree, to the hirer, to the owner of the business. The hirer is the owner of the business, while the hiree is the person using the asset. The owner of the asset is the hirer, is the hirer, while the hiree is the person using the asset. So the hiree will be paying certain installments as agreed to the hirer for a period of time. So the ownership of that asset will not pass to the hiree until he has paid the last installment. So that is what we call, it's a contract between two parties in which the hiree pay a certain installment to the hirer for the use of the asset. And the asset will not pass to to the hiree until the last installment has been paid. So the next one is lease. Lease. In a lease agreement, we have what we call two parties. We have the lessor and lessee. The lessor is the owner of the asset, while the lessee is the person using the asset, and he will be paying a certain agreed fee at an agreed period, usually called what? Rent. So you'll be paying rent for using the asset as agreed by the contract, as contained in the contract. So under this we have what we call the finance lease and the operating lease. So that's a topic on its own which we are going to do what we are going to take later. So we have operating lease and finance lease. So a topic on its own. This is also another form of raising finance. You don't have the capacity to do what? To buy the asset at once. So you now tend to do what? To approach somebody who has this asset. You pay for the asset, and you don't pay for the asset, you rent the asset, and you are paying something what we call rent to the owner of the asset. So it's a source of, take for example, you need a particular machinery, a particular machine to produce in your company, but you don't have the finance to do what? To buy the asset outrightly. So you approach a lease company, so they will lease out the asset to you, and you use the asset and pay certain agreed fee for a period of time. So we have operating lease and finance lease there. So lease and sales and lease back. Sales and lease back. In this type of source of finance, you are the owner of the asset. You have the asset yourself. But you still need money. You still need what? Cash, fund, to do what? To run the business. The asset is there. Yes, the asset is there. The machinery, for example, the machinery is there. But you still need you still need finance to do what? To put the machinery in work, in force, to make the machine work. For example, you are producing a manufacturing firm, you have the machinery, but you don't have the raw materials, you don't have all other things, raw materials, to do what? To produce. Or you have the machine. What are you going to do in this case? You sell the asset. You receive you still sales proceed from the asset, but you still need that asset to do what? To produce. What we now do, you sell the asset first, what we now do, you now lease it back from the what to, from the person you sold the asset to. So therefore, the original owner will now be what? Will now be the what to? Now be the lessee now. So because he has sold it, so he's now leasing it back. So you sell the asset, you now lease it back because you still need the asset. But you need fund to do what? To do other operations. So that is what we call sale and lease back. So you sell and you lease it back. So the next one is what we call the venture capital. So venture capital, another name for venture capital is what we call what? Business angel. Business angel. This is a situation where owner of capital provide fund to a dying organization to survive. So an early company, that is to say, a company that is almost running bankrupt, it doesn't have the fund to finance its operation. So you have some owners of capital who can provide this capital for the company to do what? To survive. So these are what we call what? Venture capital. You approach them and they survive, or they put fund, they fund the business for the business to do what? To continue running. So that's what we call venture capital. Venture capital. So the next one there we have what we call what? Project finance. So under project finance, so the project itself is used as a collateral for that what? For that fund. What I mean by that? You don't have fund to do what? To run that project. You have a particular project in which you want to embark upon, but there's no fund for you to do what? To run the business. What will you do? Approach a financial institution. So what do we now do there? So you don't have fund to do what? To put down. You now use that project itself. They'll finance the project and now use that project itself what? As collateral for that loan given to you, for that money, cash, fund given to you. So that is what we call project finance. Project finance. Now let's quickly look at the long-term source of finance. Long-term source. So under the long term, what do we have? What are the method of raising the long term? We have method, we have the long term here. We have what we call the venture, what we call what? Preference share, ordinary shares, and what? Retained earnings. These are long-term source of finance. Yes, these are long-term source of finance. So the venture, preference share, ordinary share, retained earnings. So these are basically what we normally use when we consider we are talking about what? Cost of capital. These are basically anyway, all these source of finance has their own cost. Anyway. Well, these are the long-term source of finance that we are talking about here. Why? Because they expand the period of payment, if any at all, is what to is long-term. You just put it there for it to be running the business. What are you expecting from it? The providers of this capital, they are expecting what? A certain return from their investment. So the venture, what is the venture? We call this, another name for this, in the public sector, in the private sector rather, we call it the venture. While in the public sector, we call this what? We call it bond. We call it bond, either the state bond, the federal government bond, the sukuk bond. It is issued by the government, we call it bond. It is a form of what? Finance, all sorts of long-term finance to the company. So the company uses this source of finance to do what? To finance its business in the long run. So the venture is used. People what? Invest in all this. People invest in what? In the venture, which has what? A fixed rate of interest. When you say the venture is a what? Is a secured loan. It's a secured loan given to what? Given to that the company uses to finance its operation. Type of what? It's also type of source of finance. So, when we say business is what? Is a separate entity, different from the owners of the company itself. So the company needs to survive by to making use of what? Of certain funds. So these are the long-term source of finance, the venture. So when we are talking about, when we get to under long-term source or under cost of capital, we're going to explain this. We have done that before. Just watch my previous videos where I've discussed what cost of capital. You will see where I've done justice to the explanation of the venture. we have what we call redeemable debenture and irredeemable debenture. So I've explained it. Just scroll down to my videos, just go to the what to playlist. You see where I discuss cost of capital. Open it, see, you see what we are discussing. What we are talking about, what debenture, redeemable debenture and irredeemable debenture. I've explained this in total. I've explained this very well under what cost of capital. Just go to the playlist, click on the playlist, open it. You see the topics I've treated you see the subtopic I've treated under cost of capital. Debenture is there. Preference shares. So preference share is another form of what raising long-term source of finance. So they are the owner of the company. Basically, they are the owner of the company. Anyway, we have two schools of thought. We are explaining preference shares being part owner of the company or not. There's a question whether preference shares holders are part owners of the company or not. So we have these school of thought. Some say that what preference shareholders they are not part owners of the company, while some say that part owner of the company. I'm also referring you to that page, to that playlist, cost of capital. I explained that in details too. So it's also another source of what long-term source of finance. From that day, it's moving to the future. So ordinary shares. Ordinary shareholders, people subscribe to this. How the company do this? They go to the primary market to do what to source for this. They issue debenture, company issue debenture for them to do what? For people to come and invest in such a debenture. Or preference share, company issue preference share for people to come and invest in it. Ordinary share for people to come and invest in it. So people bring in their money, buy certain portion of all this investment. These are investment. Buy part of it, certain portion of it, and what to give the money to the company. So the company now uses to finance its operation. So we have debenture, we have preference share, we have ordinary shares. Retained earnings. What is retained earnings? As the name implies, this is the portion of the earnings of the company retained for business expansion. Retained for business expansion. That is to say, out of the profit of the company does not spend everything. It retains certain portion of it and reinvest it into the operation of the company for expansion purpose. That's what we call retained earnings. So if a company makes 100, let's say for example 100 million this year, so and it has viable projects, it intends to retain 30% of that 100 million. I mean net profit. I'm talking about net profit now. I'm talking about net profit now. You make a net profit, net earnings of 100 million. It intends to to retain 30% of it and pay the remaining as as dividend, as the case may be. So from there, it has that to do to plow back into business expansion. Now looking at ordinary shares. What are the ways of raising ordinary shares? We have public subscription, rights issue, placement issue, conversion of shares, offer for sales by tender. So those are the ways of raising funds through ordinary shares. So that the source of raising funds through ordinary shares. What we call public issue, public subscription. A company that needs finance, we just go to the primary market and issue part of shares to the public. That's what we call public subscription. For the public to do to subscribe to it. People who has fund will come and invest, buy certain percentage of the shares, of ordinary shares, and they pay, whereby the company uses their fund to do to finance its business. So right issue. What is right issue? As the name implies, this right issue is only given to is the right of the existing shareholders. Is the right of the existing shareholders. It's only, that is to say, it's only the existing shareholders that can subscribe to this issue. It's only the existing shareholders that can subscribe to this issue. The difference between this, anybody can subscribe to this, but here it's only the shareholder that can subscribe to this issue. So, placement issue. What do you mean by placement issue? So that is a situation whereby the company decide to do what? To have a private placement. So it's a sale of stock to pre-selected investors and private institutions rather than on the open market. So when you say placement issue, is the sale of what? Of shares to pre-selected investor rather than giving it to the total to the public. Pre-selected investors, you have some investors in mind which they want to do what to, they want to sell this to, rather than giving it to the general public. Pre-selected investor, private investor. So you have the response through this means too. Conversion of shares. You can convert your shares from what? From private shares to what? To ordinary shares, or from debenture to what? To shares, or vice versa. By that conversion, therefore, you also was trying to raise a fund. Offer for sale. What is offer for sale? So it's another form of what? It's another form of raising finance for the company. So offer for sale is a mechanism that allows promoters to reduce their holding in a listed company transparently. So these shares sold by the promoter are offered for sale directly to the public through a bidding process. So when you say offer for sales, you allow the public to do what? To bid for it at the price in which they want. So at the end of the day, the company will now come out with what? With a general price, which will now call what? The striking price. So that is the price in which it's going to do what? Revalue the share subscribed and give it so that it's able to have a uniform value at the end of the day. So offer for sales by tender. So offer for sales by tender is another way of raising funds. So offer for sales by tender. Here the buyers are allowed to bid for the shares at the price to be determined by them, and later the company determine the striking price. Yes, price that will absorb the old shares. That is offer for sale by tender. While offer for sales is a mechanism that allows promoters to reduce their holding in the listed company transparently. These shares sold by the promoter are offered for sale directly to the public through a bidding process. They bid for it. So, but under the offer for sales by tender, you allow the investors to do what? To bid for it. So at the end of the day, the company will now have what we now call what? A striking price. So it is under the offer for sale by tender that we have what we call the striking price. So now this here is what we call what? Offer for sale by tender. It is essentially by what? The company allows the general public to bid for it at any price in which they want it. So by that, therefore, at the end of the day, the company will now come out with what we call what? The striking price. That is the price that will absorb all the old shares that the company has offered in order to raise the required fund. At this junction, this is an explanation on sources of finance of the company. So therefore, critically looking at this, we are still coming back to solving question on what we call right issue. How does the company do what right issues? So how does it happen? It's only the right of what? Of the existing shareholders. So the shareholders here, the existing shareholders has what? Options. That is to say, has options to do what? To buy the right, has the option not to buy the right, has the option to do nothing. Altogether, you can buy the right, you can sell it, you can also what? Buy some and sell some. And it may even not do anything at all. You may buy the right. We ask for options to do what? An existing shareholder has 4 options under this right issue. The right to do what? To buy the right, to subscribe to the right, that is to buy the number of shares issued to him at a certain proportion. So he has the right to buy. He has the right to do what? To buy and sell. He has the right not to do anything at all. And he has the right to buy some and sell some. These are the 4 options available to what? To an existing shareholders under the right issue. So from there, usually most of the time, the right price, we have what we call the right price and the market price. The right price is always different from the market price, and also almost all the time, always the right price is always lower than the market price. The right price is always lower than the market price. So at the end of the whole exercise is a new price where we call what? Theoretical extract price. So this is a topic, this is a subtopic under what? Under this source of analysis, which I'm going to look at. So I'm going to solve question and see how this behave, see how the investors do how investors behave when it comes to right issue. At this point, thanks for listening and watch out for my next videos. If you have not subscribed to this YouTube channel, kindly click on the subscribe button and subscribe and watch my previous videos. Put your comment in the comment section. Give me what? A thumb up. Give it a thumb up and what? Put your comment and I'll be glad to do what to respond to your comment and any question we have. At this point, I'm going to call it a class now. Thanks for listening. See you next time. God bless.